going to take you through 3 strategies to deal with superannuation and how to reduce what we've sort of termed the death tax, and also then look at some non-superannuation strategies and how to deal with effective transfer of your non-superannuation assets. First strategy I'd like to introduce you to is a withdrawal and recontribution strategy. Now, this strategy gives you the opportunity of reducing the tax on your superannuation death benefit payment to 0. It simply involves the withdrawal of money from superannuation and putting it back into the super fund. There's a couple of critical points that need to be noted. You can't take money out of superannuation unless you've met a condition of release, and generally for most people that is you're over 65 or you have retired. Unfortunately, you can't just pull out the taxable benefits. You have to pull out the tax-free and taxable amounts in the same proportion as what they exist in the fund. The use of pensions makes this strategy more effective, because when you start a pension, the amount of tax-free that is benefit that is used to start that pension is locked in for the life of that pension. Let's look at an example. Homer and Marge are retired and their superannuation is in pension phase, and they've got 3 non-dependent children. If they died now, Marge's estate wouldn't have to pay any tax on the benefit. But Homer, who's got 2/3 of his benefit that are taxable, his estate would incur tax of $165,000. Now, I'm sure their kids, Bart, Lisa and Maggie, wouldn't be all that happy paying $165,000 in tax. So let's look at a strategy to help them. It's effectively a 3-step process. First step, we're withdrawing $900,000 from Homer's pension. He's the one with the taxable component. And then, after it's been through their bank account, we're putting it straight back into the fund, $450,000 for each of them. We immediately start a pension with that money, which locks in the tax-free nature of the contribution they've just made. If we had left the money in accumulation phase, the earnings on that money are taxable. And so gradually, over time, the effectiveness of the strategy is reduced. So this is what it looks like now. Homer's initial pension has been reduced by the $900,000. They've both got 2 new pensions in the fund. The potential tax on Homer's death benefit has been reduced by about $100,000. It's now around about $66,000. That's a pretty simple strategy to save $100,000. By making the $450,000 of contributions, they've maximised the amount that they can put into the super fund for the next 3 years. Also, if you're over 65, you can't contribute to superannuation unless you meet the work test, being you've got to be able to work 40 hours in a 30-day period. In Homer and Marge's case, they're pretty lucky because they're only just over 60, and so they're going to have time to redo this strategy. In 3 years' time, they've had good investment returns, their balances have grown, even though they've been taking the minimum pensions out to satisfy their income needs. And so the strategy, once again, 3 steps. In this time, we take out all of Homer's pension and we put it back into the fund. Once again, we start pensions. Let's have a look at the end result. Marge has got 3 pensions, Homer's got 2, but now that that strategy's all done and all the money is tax-free benefits, you can actually tidy up the fund a bit and roll those pensions all up into one pension for administrative ease. But most importantly, there's no tax when they die. So through a pretty simple strategy, you can save, in these guys' case, at least $165,000. But as the money grew in their superannuation fund, that $165,000 tax would actually grow more. The next strategy I'd like to introduce you to is one I've called Pick the Pension, because it didn't really have a name. So, and this one is you use it when you've got more than one pension in your super fund, and you've got different taxable components in each of those pensions. The idea is you focus on drawing out the most you can out of the taxable pension, and only draw the minimum you required out of the pension that has the most tax-free. Now, let's look at an example. Barney, he's 65 and he's retired. Last year, he sold his house and was able to put tip another $400,000 into his fund just before he turned 65. He initially had one pension in the fund and it was predominantly taxable. And that's his second pension that he started with the new money he's just put in. Barney needs $50,000 a year to live off. Now, he could just draw the money equally from each pension and that would be fine. Or he could draw the minimum required, which is 5% for someone of his age, out of pension number 2, and draw the rest of his income needs, being $30,000, from pension number 1. The impact over time is that he's drawing down on that pension with the most taxable benefit. Now, I know this probably sounds pretty simple and straightforward, but you'd be surprised how often this isn't done. Stepping forward, Barney actually dies when he's 80 years of age, and his sole heir is his 50-year-old son, so not a dependent for tax purposes. So when he dies, these are roughly the balances that Barney had in his fund, and his death tax that his son's going to have to pay is around $65,000. Now, it seems like a lot, but if he had have just drawn equal pensions, the death tax would be around $76,000. So, $11,000 tax saving. But if Barney had lived longer, the saving would have been more because his second pension would have continued to grow while he was drawing down on that first pension. The third strategy I'd like to introduce you to is one surrounding terminal illness. About 18 months ago, the government changed the rules with superannuation, and terminal illness was included as a condition of release, which means you're able to access your superannuation benefits. Now, an individual who satisfies the definition of being terminally ill, that is, they've been given less than 12 months to live, they are then able to take their money out of superannuation without paying any tax. Let's look at an example. Joan's 45 and she's been fighting cancer for a number of years. She's got 2 non-dependent children, both out working, and she's recently received the news that she's only got around 6 months left to live. Now, she had $350,000 in a superannuation fund, but she also had life insurance through the fund. Now, her life insurance, like most life insurance policies, also had a terminal illness clause. So her total benefit is $1.35 million. Now, she could just leave it and let things be, and when she dies, her children can collect the money from the superannuation fund. However, if she did that, there would be tax of $335,000 payable. So as you can see, if she was to take the money, having satisfied the terminal illness qualification, there's a very significant tax saving. Not only is it tax saving, but it also gives her the opportunity to be involved with the distribution of those funds to her beneficiaries, to be involved in planning the family's finances. There could be an added advantage for her if she was from a blended family, perhaps a second marriage, and perhaps there may have been risk of a contest of her will upon death, and so perhaps she may have been able to transfer her assets through to her beneficiaries before she died, avoiding any contest over those particular assets. Another version of this strategy is for those who are quite elderly and becoming frail and perhaps have a limited life expectancy. In those cases, it might be worthwhile paying the money out of the superannuation fund and just holding it in that person's own name. Of course, it's not as tax efficient as having the money in superannuation, but it sure beats paying death tax when they die. Because when they die and the assets are in their own name, they just pass through their will to their beneficiaries. So that's superannuation. And Glenn's shown us how we can actually get our superannuation through to our estate through a binding nomination. Let's look at some of the options that you've got in terms of your estate planning and what is available to you. First one I'd like to draw your attention to is a testamentary trust. Now, a testamentary trust is established through your will. It allows your personal assets to be held on trust for your beneficiaries without them actually receiving those assets. This sort of strategy may be of advantage if you've got minor children, because minor children who have unearned income are taxed at penalty tax rates. If you've got beneficiaries who are spendthrifts, or perhaps have a gambling or drug addiction, it's a way of protecting the asset that you've worked hard for all your life from being frittered away. The other advantage might be that if you've got your beneficiaries who may be at risk of bankruptcy, either through their business interests or perhaps their own personal circumstances. A testamentary trust allows those assets to be held for the beneficiaries without incurring any capital gains tax on the transfer of those assets from you to the trust. So the full value of those assets are therefore being able to be utilised by the beneficiaries. If you're looking at using this strategy, you need to seek specialist legal advice. With your personal assets, another pretty easy way to preserve wealth is to make sure that your executors have the opportunity to transfer assets rather than cash to beneficiaries. By this I mean that your executor doesn't just sell up everything and then transfer the money through to beneficiaries, but actually gives each beneficiary a pro rata share of the assets. Now, an easy example, $1 million worth of BHP shares with an accumulated capital gain of $500,000. Now, if the shares were sold by the executor, in this case, there'd be $91,000 of tax payable. So the amount of money paid through to beneficiaries is reduced by that tax. The alternative is for those shares to be transferred through in specie to the beneficiaries. The gains transfer through to the beneficiaries, but then they have the opportunity to manage the capital gains tax outcome themselves. And particularly when you're transferring assets from one generation to the next, generally that next generation is younger and has the opportunities available through either superannuation or other means to reduce the impact of the capital gains tax. The final strategy, which is a fairly straightforward strategy, which probably a lot of people in this room actually already practice, and that is owning assets in joint names rather than owning them in their own individual names. Generally, the most common asset that you see this with is the family home, where husband and wife own the home jointly. When one passes on, the survivor inherits that automatically. It doesn't go through the deceased's will. So if there's a situation of perhaps a blended family relation, second marriage, that type of situation, it might be important to those parties to make sure that that asset doesn't go through the deceased's will, and joint ownership is a way of achieving that. Many of you here may also have other structures in place, family trusts, companies, or even own business assets either in your own names or within those structures. It's really important that the control of these entities is dealt with through your wills. Your will cannot dictate what's going to occur with the assets owned by these different entities, but it can deal with the transfer of control of those entities. This is a specialist area. You need to make sure that your accountant and your solicitor and your advisor are working together to make sure that the outcome that you desire is going to be achieved. For those of you in business, one of your largest assets may be the value of your business, and succession planning is a really important part of maximising the value of that asset for your family when you're no longer around. Once again, a specialist area and beyond the scope of today's presentation, but certainly one that you need to consider.